Peter, how are you, man?
Good, Ryan. How are you?
Doing good. We were just laughing because we just got done having a couple of fun conversations about it's been 2.5 years, man, since you were on the show, and there's been some. You bought a couple domains that helped clean up your brand, and we won't get into that, but it was maybe a smile, and yeah, lots gone on in the world of M&A and buyers and the money that's out there, and so I saw you post something about you had gone to a conference or something like that with Brent Beshore, and I just love everything that he's doing. So I saw that, had to reach back out, and here we are, man. Super excited to have you back on the show.
Thank you for having me. And for those of you curious about Ryan's comment, I'm happy to share the story. But
Yeah, do it, man. I got to hear it.
I think our brand has been clean as a whistle since day one. Unfortunately, there was a sex toy business that had a very similar overall website. We owned .co and .net, and they owned .com. And I finally was able to wear him down and buy Axial.com. So what we really did, I think, was clean up his brand, not clean up our own.
Here you go there. Good thing. Thanks for the clarification. So immediate digression. This is going to be a fun hour. All right. So for the people that have not caught your previous episode or are not familiar with Axial, why don't you just give us a little bit of your background and then what Axial does and where you spend most of your time these days?
Sure. So my personal background, professionally, I started my career working for an information services business that got started in New York in 2000. Actually, late 90s. I joined in 2001. The business is called GLG. The original name was Gerson Lehrman Group, but they shortened it to GLG. It was co-founded by my brother Thomas and Mark Gerson. And the business made expertise and insight available on a near on-demand sort of real-time basis to professional investors. So we built a marketplace of experts all around the world, and we connected those experts for live private calls and conversations with professional investors. And it was a way for investors in all types of companies of all shapes and sizes to speak with experts very quickly and understand businesses and important topics very, very quickly. I spent 6 great years there. Business grew really well. We served a lot of different customers in America and then around the world. I got to live in London and set up an office for us in Shanghai, and then went to graduate school in 2006. Spent 2 years in graduate school out in California at Stanford, which was 2 great years. And I interned for an investment firm that was a private equity investment firm that was investing in small, very small, mostly family-owned and founder-owned businesses in America, overwhelmingly businesses in the testing, measurement, and instrumentation category, which is a pretty arcane category of really interesting, really highly valuable businesses that have really, really strong competitive positions. And the challenge of finding these businesses, identifying them, knowing which businesses they were, knowing how big the businesses were, just size-wise, just general size, approximate size,
Mm-hmm.
as well as trying to know whether or not the business owner was thinking about a transaction and was open to a transaction, either a recapitalization that kept them involved or a full cash out. All of that information, this is in the mid to late 2010s, was just nowhere to be found. Nowhere, couldn't find it on the internet. Didn't matter, Yahoo, Google, nothing, no specialized tools could sort of help you uncover that. And so the bottleneck in the investment business became largely about finding great opportunities and putting yourself in the right place at the right time to find those opportunities and to partner with those entrepreneurs. And then as capital poured into the private markets, that bottleneck only became more acute and more of a
Mm-hmm.
sharp bottleneck for buyers of businesses. So so I ended up starting a company in 2009. Axial website is axial.net, and now luckily axial.com.
And.com.
You can go to either one. And Axial is effectively an introduction platform on the internet that confidentially introduces buyers and sellers of small and mid-sized American businesses, and does it in a way that respects the confidentiality and the privacy preferences and the agency of the seller. So the seller is driving the process and deciding who they want to engage with and when they want to engage with them and on the terms that they're comfortable with. And that platform is 100% software-based and software-led. and is focused on just generating literally hundreds of thousands of targeted, high quality introductions between active pre-qualified buyers and active vetted pre-qualified sellers. And we do that as that's the core business, is making those introductions, facilitating those introductions, and using software and data to change the game of deal sourcing for both the buyer and for the seller's benefit.
Yeah, and I love it, man, because when you and I talked years ago, I've learned a lot since, and one of your things that you even said on the website, but is also that you mentioned in our previous interview, is the inefficiencies in the lower market. And I think a lot of the themes that we want to talk about today were like, in you, just to kind of rattle off a few, and we can take these in different chunks, but like the amount of capital sloshing around, the amount of people going down market, the different types of buyers that are coming around, and all just there's just such a hyper focus now on this, even more so, I think, because of COVID and the baby boomers and just a lot of macro trends kind of like pushing people this direction. But before we just kind of pick, some of those topics to unpack, what when like your definition of inefficiencies? So like maybe give us some examples of like what do you mean by inefficiencies? What were you trying to solve? What like different like parts of that bottleneck that you kept seeing? Like what maybe kind of give us some examples.
Yeah, sure. I mean, the most, important thing to remember is that if you are an investor in public companies, you can deploy capital basically instantaneously, right? If you decide you want to buy $100 million worth of equity in Apple or Google or Facebook or 3M or Exxon or Chevron or a whole host of other, multi-hundred
Hmm.
million, multi-billion dollar businesses, you can pull the trigger on that. It's not just, buying 100,000 or 200,000. You can build huge positions quickly in those businesses because they're publicly traded. And you don't have to meet the CEO, you don't have to meet the owners, you don't have to go and fly to Texas and meet with the CEO of Exxon to talk about investing, 10, 20, 100, $300 million in the equity of their business, right? There is a really high performing marketplace where those shares are trading freely among and between, free and willing and able buyers and sellers. That's not the case when you're buying small businesses. You can never do a deal with a small business owner until you've met the owner. You have to meet them. There's really no other path. So the question is, how are you going to meet many, many, many hundreds of small business owners in a way that doesn't waste your time and in a way that doesn't waste their time? And that was really the primary bottleneck that I was experiencing when I was, working for this private equity firm and looking at the deal sourcing top of funnel challenges that they were experiencing and that they were going to have intensify. There are other inefficiencies as well, but I mean, the number one goal for Axial is to create a set of introductions for buyer and seller at the right points in time, on the right opportunities, with the right types of buyers, right types of sellers. Down the funnel from that introduction, there are other really significant, inefficiencies, and some of them sound trivial, but are still quite substantive. It
Real.
can be,
Yeah.
it can be a bad lawyer who recommends a completely crazy non-disclosure agreement that no buyer is willing to sign, and he thinks that he's protecting the seller, but what he's really doing is just making it really hard for the business to transact. Or that same lawyer further down the funnel can create other problems. So there's inefficiency in document preparation, there's inefficiency in what are fair and standard terms to transact at different sort of key aspects of a transaction. There's also a lot of inefficiency just in terms of the due diligence process, right? So
Hmm.
any buyer who's going to buy a private company is going to need to spend a significant amount of time making sure that the financial condition, the legal condition of the company is as represented, right? It's consistent with how it's being
Hmm.
represented. And there's a lot of inefficiency in that aspect of transaction execution because most small businesses do not necessarily keep really, really, really pristine records on all of that information
I'm sorry, I'm laughing just
at
because it's
all, right? At
like,
all. It's not a
yeah, at all,
priority
right? Yeah,
at all.
yeah,
It's not a
right.
priority when
It's a
you're running
cost
your
center.
business. You're building products, you're hiring people, you're replacing people that may have left you, you're dealing with labor issues or labor
Hmm.
shortages, or you're not like spending the time to say, well, I'm going to get my financials audited so that 10 years from now, when I want to sell my company, it's going to happen lickety split. And so, you make, there's a whole bunch of like deferred maintenance, essentially business maintenance, that you've kind of
100%. Yeah.
deferred, right? And when it comes time to sell the business, you have this huge pileup of maintenance, and it's got to all push through this narrow hose, because the buyer ultimately won't close without sort of marching through that
Hmm.
checklist of usually pretty reasonable requests. So yeah, there's inefficiency from the discovery layer, where who's going to buy my business, why would they want my business, why are they a great partner for my business, what are they going to do with it. There's all of the inefficiency around that, and then just getting to the finish line has there's a lot of hard work there. And I think over the next 10 years, we can make a lot of that hard work more effective and more productive.
Yeah, amen, man. And I think just it's almost like when you really start unpacking it, it's almost a freaking miracle that these deals get done. Almost like because
Yeah.
of how I mean, we had a couple clients that recently sold, and every deal dies 1,000 deaths. I heard that once years ago, and I was like, yeah. And I'm pretty sure my clients experience every single one of those mini deaths along the way.
Yeah.
And it's
Yeah.
and a couple other parts too, like and I'm curious on where the education stands, because like I'm trying to tackle this problem in our company is from the education side, because like you even get to that point where willing buyer, willing seller, they go through this introduction, and now like how is like the uniform or standard of like, hey, what does value mean, and how do you value these things? I mean, I don't know if you see like where that falls into the essentially the chain of events, and okay, like how far off are we from just like expectations and like what we understand.
Yeah. Well, I mean, I think the good news, I mean, the education, I think we've made a lot of progress, I think, just as an industry and as a group
Mhm.
of entrepreneurs and operators that care about the effectiveness of capital markets for private companies. I feel like we've made a lot of progress over the last 10 years, whether it's, I think we've all made contributions, whether it's the Intentional Growth podcast, or whether it's some of the work that guys like Brent Beshore have done. Obviously, Axial's tried to sort of pull our fair
Mhm.
share. But I think that, if you look back 10, 15 years on the amount of relatively high quality educational content and courses and information that is available, I think we've made a huge, huge leap forward in terms
Mhm.
of people that are putting out content in the form of podcasts, books. Maybe now the question is really sort of filtering through all of that and figuring out sort of what's most germane for me, business
Mhm.
owner A versus business owner B, or what's more germane for a startup entrepreneur versus a more mature small or medium sized business. But I think education has come a huge way with the benefit of time and the
Mhm.
incredible powers of the internet, right? I mean, it's just we've all been able to produce really great educational content, or at least some really good educational content. And I do think there are a lot of entrepreneurs and small business owners that really listen to it. They listen to
Mhm.
some podcasts, or they read some books, or they thumb through some articles. And I think that that's really helped. I think valuation is probably a more tricky subject. Um,
Yeah.
and sort of like agreeing to value. And I think getting good information on value and valuation and true comparable data sets for a given business, those are harder things, I think, to get the buyers and the sellers to align on. But I think the fundamental layer of education for business owners, I think, has made a really nice step forward over the last 5 to 10 years. And that's been a good thing for both sides. I think there's more room for sure. There's plenty of sort of folks that are just not aware of what it takes to successfully sell a business, and that enter into it too lightly. Still, there's
Mhm.
plenty of that. But I think that we really have made a nice dent in some of those education and readiness challenges over the last 10 years.
That's encouraging and good to hear. And I'm curious, like in your introductions and the market making that you're trying to do, like when valuation and terms come into play, like how fast like in the process do you introduce that? Because like I think about like like the clients that we work with, whether through the education or CFO service or whatever it might be, or the people I talk to, it's like I mean, like, we gotta start somewhere. It's like you're not gonna apply for a job if you're normally, like, looking for a $100,000 job, you're not gonna apply for one that's 30 grand. Like, and so you kinda gotta go, I like, the job description is fantastic, but, like, what's the pay? When that's, like, the valuation. And then there's, like, the, "Oh, by the way, when and how am I gonna get that money?" Like, where does that get integrated into your process? And are you seeing it, or, like, the most effective process? How do you introduce that?
Yeah, so I mean, we do not prescribe a point in time that buyers and sellers and the advisors who are being entrusted by the seller to run the sale process. We don't prescribe a point in time where that sort of alignment needs to take place. What we usually see on our platform, because our platform is arranging the introductions, digitally, and what we usually see is a relatively standard process. If a seller of a business is executing a relatively standard process of engaging with a variety of buyers at a relatively concurrent set of points in time,
Mhm,
the way in which sort of price and terms are put on the table is after NDA has been signed, there is usually a couple of weeks to review the more in-depth materials that summarize the business, and then the seller's advisor is typically laying out a process, sort of like, here's how we're going to go from where we are today to a closing of this transaction. And one of those stages is just providing initial indications of interest in the business.
mhm.
And it's not a binding offer by any of the buyers, but nonetheless, you have to take out the pen and you have to write, and there's a purification process of the buyers, but because some just aren't going to put together a professionally written initial indication of interest. And so the indication of interest is sort of where the buyer sort of says, based upon what we know and based upon the representations from the seller, based upon our understanding of this business and businesses like it and our work in this industry, here's the range, here's the pricing range, or here's the rough range that we could imagine. And sellers are reviewing a variety of indications of interest, typically from a variety of buyers, and trying to get a sense for who do they want to really begin to spend time with, right? Because you can't necessarily spend a huge amount of time with a huge number of buyers.
Mhm.
So, I think that process very often can happen within the first month of a
Mhm.
formal, a formal engagement with buyer, with a set of buyers. I think if it's not happening by the end of the second month, there might be good reasons for it. But I think that, to your point, Ryan, if you're not getting a little bit aligned on pricing and terms relatively early on in the process, you know, it's kind of like when you were saying,
What's
like,
the point?
you
Yeah.
go, what's the point, right? It's kind of like going through an interview process. You want to get paid $100,000. Their plan is to pay maximum $40,000, ideally $30,000. You're going to end up loving one another and then, leaving one another at the altar at the, in
Yep.
the bottom of the
Yep.
ninth inning. So there's good alignment up front. It usually happens in the first month. Now, if it's not a formal process, right? And a buyer has approached a seller on an unsolicited basis, it's just emailed the CEO and says, I'd like to buy your business. I mean, then I would think that
Almost right off the bat, you're like, "Hey, what do you
I
what"
would think,
like,
yeah, I
yeah,
would
yeah.
think it's unusual for that not to be even more immediate.
So, like, in the typical, like, marketplace right now, as, just to kinda put some parameters and different concepts here, like, the intermediaries have been driving a lot of the marketplace here. So, on the lower end, you got the brokers who people, give them an analogy of, like, real estate brokers because it's more like website listing, they blast the website, it's gonna be mainly an asset sale, and just, you're gonna get less of the deal structure. There's just a whole different kind of set of characteristics on the bottom part of the market. Get to the larger part of the market, call it, a few million in EBITDA and more, you get a whole different set of investment banking and stock sales, all this stuff. And then there's I call it the no man's land, which is, like, unfortunately the heart of American business, which is, half a million in EBITDA to 2 million, where you kind of
Yeah.
go, okay, like, where do I get my help? So, like, that's one of the biggest huge inefficiencies I've seen in the marketplace. Have you seen the same thing? Are you seeing trends going a different direction? How does Axial in your marketplace fit into that situation?
Well, that's a really interesting issue. I think you're right. And I think, I mean, I'm not sure it's Yeah, I don't know if it's an inefficiency or if it's just something. There's a structural. I think there's a. I think it's important for business owners to sort of understand maybe where some of this challenge comes from, right? So the way to think about it, maybe if you're working backwards from a business owner, you have to understand that if you're a financial intermediary and your responsibility, your stock and trade, your profession is to sell businesses, right? If you're extremely good at that and you're extremely well trained and you've been blessed or you've worked, hard to put yourself in a position to go and advise, you know, bigger companies, you're going to make a lot more money as an advisor advising bigger companies. And the primary reason for that is that the size of the dollars is rising faster than the percentage success fee is falling for a given M&A transaction. So, selling $100 million business and taking a 2% fee is going to generate a much, much bigger fee outcome than selling a business for $1 million and charging 10%, right?
Mm-hmm. Mm-hmm.
And so that's one reason why there is a lot of high quality M&A advice that tends to move its
Rise to the
way
top
to the
of the
larger
market. Yeah.
businesses. The other reason, which I think is less talked about and is maybe less obvious, but is actually probably just as important, is that in some ways it's a lot easier to sell bigger businesses than it is to sell smaller businesses. And the reason for that is maybe obvious, but in case it's not, small businesses have far less of a finance function. So they're typically far less equipped and prepared to handle the requirements and the due diligence requests of a professional buyer. In many cases, they don't have annualized audits and other highly verifiable financial statements and other indications of information on the business that can be relied upon. And so when a business is bigger, it can afford those audits. It's typically getting those, it's pursuing those best practices already. And so you can snap your way through those M&A sales. I mean, look, doing M&A is never easy. These are huge handmade transactions, but it's just easier. In addition to getting more dollars for it, it's also easier. It's not as complicated. There aren't as many loose ends. And so what that does is create a real scarcity of great advisory talent selling small businesses. And
Mm-hmm.
I'm not trying to speak negatively on it about who's selling small businesses. It's just the better you get at it, the more you want to move up market. And
Dude,
so and so there's
I,
this constant, there's just this constant
mm-hmm.
flow of talent moving up market and, saying, well, we only want to sell $25 million businesses now, or I only want to sell $50 million businesses now. And then the lower middle market kind of has to replenish its, set of intermediaries.
Isn't
And
that?
it just creates this structural challenge for small and mid-sized businesses that is really problematic for the sellers, and it's really problematic for the buyers, because
Well, and Peter, I like how you articulated that is awesome, and and I'll add to a couple parts too. Is that the deferred maintenance is not an issue as you get bigger too. Like, so that goes back to the ease of the deal, because they're actually like doing all those things that you're talking about, and honestly, like the quality of advisors, and honestly, this was a concept that I had actually flipped my thinking on years ago, where like the cheap advisors make things harder if they actually don't know what they're doing. Like, so like if you're a buyer, you're excited to work with someone that gets it, quote unquote, because there's nothing worse with a CPA or an M&A or an attorney or someone that pretends to know what they're doing and has no
yeah.
clue. And they actually are probably doing more detrimental work on the seller's behalf than the seller even knows, because of how ridiculous of the requests are or the structure. They don't know that they're playing chess. They're still trying to play some kind of version of checkers or something.
Yeah, no, I think that's right. And so, I think what ends up happening is it just gets into this sort of negative cycle where the intermediaries say, I can't spend the time necessary to get this business fully prepared. So I'm just going to like spray and pray. And hopefully there's a buyer out there who's willing to sort of like do the work and slog it out to really figure out
Hmm.
what is the true condition of this business's financial earnings, et cetera. but I'm not, as an advisor, I'm not going to like get all of that deferred maintenance taken care of before I take the business to market. So as a result, it's just sort of like they take on a lot of assignments, right? And they just sort of like
Get
push
her
the,
done.
yeah, just push them out the door and sort of, hope that,
Well, the
that
market ends up telling them too, which is just like I mean, I've had people go through our training, Peter, like 2 years, $500,000 with advisors, failed private equity sale. And it's just like talk about inefficiencies. Like they could have spent that money growing their business. They took the eye off the ball. I mean, like it's just such unfortunate. But like to your point, like I never had as much empathy for the advisors when I started this gig as I do now. We're like, yeah, like these brokers, you're going, okay, well, if you want to make the money that you're supposed to make, that's kind of your only option because people are coming there, coming to you saying, "Hey, I want to sell my company," and they've got paper or like send me your company financials, and it's literally their tax returns. Like that's different. It's like, how would you
That's
even
exactly
represent
right.
that company?
That's exactly right. And the case is totally different if that same company says, "Hey, I wanna sell my company, but I wanna do it 3 years from now, and I'll pay you X thousand dollars every month to sort of help me get ready between now and 3 years." But when the business owner says, "Hey, I'm done, sell it," and y it's a tough position, it's a tough position for them to be in. So
So how does your marketplace handle the intermediary situation? So you because like I like one of the things that I'm super impressed with it. I mean, you mentioned right from the beginning is sellers are driving the process, and it's like it's business owner focused. So like with the fact that a lot of owners do it once, maybe they don't have this expertise. Like, how are you getting the expertise and intermediaries, and how do they fit into that process?
So the intermediaries, so our software and the introduction platform that we've built, which is all software based, it's all available to the intermediary community as much as it is available to owners of businesses directly. And that's been our choice in the design of the business actually since day one. There are so many intermediaries in the lower middle market and in the SMB market that if you are a professional buyer of businesses, and your goal and your why you got into the business of buying businesses, it's not so that you could go and like chase down thousands of different intermediaries over the course of your career. The reason you became a buyer of businesses is because you wanted to buy businesses, either buy and operate them or buy them and then sit on the board and try and, help them. I mean, that's the profession of private equity or, buying and owning and operating. And so most people on the buy side do not really want to try and build a CRM with thousands and thousands of brokers who they're going to just occasionally interact with. And so as a result, Axial's platform makes it really easy for buyers to find deals from lots of different business owners, but also from a huge, huge long tail of financial intermediaries who use the exact same software. We don't charge the intermediaries for the core software tools that we offer, so there's no disincentive for them to use it on behalf of their clients. When I mean that, the platform is really driven by the sellers, what I mean is the seller either operating directly on his or her own behalf or through the agency of an intermediary, they're deciding who to share the deal with. So on a real estate
Got it.
listing site, you put up the pictures of your kitchen and your front yard and all this stuff, and you say your house is for sale, and anybody with an internet connection can go and see your kitchen and your closet or whatever else you uploaded to the list, right? On Axial, we don't treat the sale of businesses the way that real estate platforms treat the sale of property. We think businesses are fundamentally different because there are employees there are lots of sensitivities. People want to sell businesses very often confidentially or very quietly, and so as a result, the way Axial is built is the sellers decide who do they want to share the opportunity with.
Got it.
We give them the data on the buyers. We give them the tools to engage those buyers. We say, hey, here are the buyers we recommend, and here's what the data is suggesting about their likelihood of being interested in your business. But ultimately, you can decide, do you want to reach out to 10, 20, 100, just one, two? You want to do it all at the same time, or you want to stage it? We want to keep that control with the seller or with the seller's intermediary because what we found happens is once you want to be a platform for businesses that are worth more than $5 to $10 million, that's what the business owners want. They don't want their business for sale on the internet so that anybody can go and look at it. They want to have a lot of control over who are the buyers that they're talking to, what's the information that's being released to them, at what point in the in the conversation
Mhm.
is that information being released. So you can't just sort of create a listing and put it out there. That works
Mhm.
great in real estate. It doesn't really work very well in the purchase and sale of small business.
Yeah, well said, and, I think in the online space, I've been, in the fray of just a lot of the online e-commerce. I've become friends with the Quiet Light Brokerage or the FE International. These, I mean, like a lot of those e-commerce, the FBA or whatever, they're built to sell and they're selling them and they don't, and they're listing them, they're blasting them out. And that might be a different thing, like you said, than like, hey, there's only four of these type of companies in this state. Like, if I put it up there, people are gonna know it's probably me.
Yeah. No, that's right. I think there are certain kinds of businesses where you can triangulate on the identity of the business if you have a few data points, and that tends to make business owners even more sensitive. That makes them very sensitive to disclosing location of the business because usually that's one of the most powerful data points for triangulation
Yep.
purposes.
So I was
It's
gonna.
interesting,
Oh,
in the
good.
FBA space, I mean, I think one of the interesting things is that there are certain pockets of small business M&A that can actually benefit from some standardization. And actually, FBA businesses and businesses that are sort of in that e-commerce category that are, either FBA or Shopify businesses. I mean, I wouldn't say that those businesses can be bought and sold, like publicly traded stock,
Hmm.
but those businesses are more
Yeah.
templatic in certain
Yeah.
ways,
Ooh,
right?
that's a good word. I wouldn't have picked that one.
Or templatized. I don't know if
Yeah,
templatic
yeah,
is
no,
the
I'm
word,
fine.
but templatized,
Yeah.
right? There's a certain set of SKUs that they offer. There's a certain amount of inventory that they carry. There's a certain,
Setup of your Amazon
yeah,
account of
yeah.
Shopify and
And
yeah, yeah,
and
100%.
we were talking about this before you pushed record. There is growing specialization of buyers as well as growing diversity of buyers and buyer types of small businesses. And there are definitely, as you probably know, there are some high volume at scale buyers of FBA businesses. There are companies that are exclusively set up to raise capital to go out and find and buy FBA businesses. And so, because FBA businesses are so small, they have to get really, really good at doing the transactions very,
Mhm.
very quickly, and with a lot of standardization. Because the transactions are so small that the only way for them to put a lot of money to work is to, just ram it through.
Rinse and
And
repeat, rinse and
yeah,
repeat.
yeah,
Well, and you bridged to the next topic that I wanted to talk about is the diversification and specialization of the buyers, and then we can kind of get into the capital that's sloshing around and how that's impacting multiples and different types of buyers. But on the types of buyers right now, I mean, I recall when you and I had talked, one of the constraints that I had saw in the mid to lower market was just the one of the primary mechanisms of the SBA loan that's going in there, the $5 million cap, and then the fact that you can't get creative on the deal structure, have the owner stay on for a while, maybe make some income and help. Yet there's this now proliferation of acquisition entrepreneurs, search funds, ETA, acquisition through entrepreneurship, that are like now kind of, or acquisition, that are now jumping in. Like, what are you seeing as it relates to that market, or just the diversification in buyers in general?
Well, I'd say that there's definitely growth in the ETA category for sure. ETA being entrepreneurship through acquisition, where some young gun wants to buy a business as a means by which to become CEO as opposed to founding a business de novo. And the ETA category has grown in number. There are more schools and business schools that are supporting it. There are funds being raised to go and back
Hmm.
the ETA searcher. So there's definitely been just volume growth for sure in the sort of funded search fund and ETA backer category. I think there's definitely just growth in the number of kind of people that have just walked away from the more like white collar, life of investment banking or higher end sort of white shoe private equity and have just said, I want to go and buy and operate small businesses for my own account. And I want to buy them mostly with my own capital and hopefully with the partnership of the seller through seller financing and seller note and maybe a little bit of SBA debt or or maybe a couple of friends and family money, but no fund is being raised. I'm really doing this because I just don't want to
Do it for
do
someone
this.
else.
Yeah, exactly. I don't want to do it for someone else. I don't want to be at some huge fund and chasing the next huge deal. I really want to do this. And we're seeing, I mean, I'll give you a really cool example of this. There is a investment firm that was started. They're in Boston, and the name of the firm is Shaker Hill. And it's not necessarily that significant, but I just want to put the name out there.
Hmm.
They're they're clients of Axial. They use Axial to find businesses to buy. The two founding principals were professional money managers at Fidelity. They were managing huge pools of capital in mutual funds and other actively managed accounts. And they moved on and they said, this is not the life we want to live. This is not the kind of work that we want to do. We don't want to just be sitting here picking stocks that we have nothing to do with. We have no connection to the management team. And they bought a chocolate business last year through Axial or earlier this
Why
year.
not? I love
Uh,
it.
and it's called, they bought a chocolate business and they reached out to me and just sort of said, thank you so much for helping to create Axial and creating this platform that's, allowed us to pursue a new chapter in our careers. And there's a lot of that. Like there really is a
That's
lot of
awesome.
that. And it's not just happening from folks that are graduating from business schools. It's happening from people who are gainfully employed, working in finance, working in corporate law, maybe working for a big industrial conglomerate like a Danaher or a 3M or something like that. I mean, we're sort of seeing it happening from anywhere. And that is really, really exciting because as a business owner, that, I think it used to be a little bit more true that, if you were selling your lower middle market business, you were selling it to a kind of professional down the middle private equity firm or a corporate strategic buyer, like a competitor or a strategic buyer, that
Hmm.
was sort of in your trade and in your category or in an adjacent category. And those options still exist most of the time, but you have these other options now that you can begin to contemplate, and they're not random sort of pie in the sky potential alternatives. There really is, real volume of buyers in the market that have that more modified sort of demographic
Hmm.
profile, and that's pretty interesting for business owners.
Totally agree, man. And like the ability for these buyers who might have an operational expertise or like looking from going from Fidelity to chocolate. But like I think what's interesting about it is, and I don't know if I'm curious of your thoughts of kind of some of my observations in the last handful of years is that you have more of those people that are going, okay, this is an opportunity, and like, hey, I don't. There's less like I'm okay in maybe a dirty industry or something like that because it makes a bunch of money. And like, hey, like
Yeah.
the ego tied to like the skyscraper and the white collar stuff like you're talking about. It's like, what's more, the 90-hour grind or working a little bit less, managing, in the, a lawn business or, HVAC. But so I think there's some of the operating pressures or trends happening, but the capital and now the proliferation of capital that has been injected in the marketplace that's looking for a home to get yield is just insane. Like, I mean, I've watched traditional private equity firms that wouldn't touch anything over 2 million bucks in EBITDA because, you know, I saw that kind of as this arbitrary threshold because, anything above below that, you're all of a sudden getting more into the operational weeds where like you can't just hire EY at a $500,000 a year to go fix your shit. You have to like go in, roll up your sleeves, and do it yourself because the cash flow can't support the consultants. So the money's pushing these people down, and that ETA buyer or the search funds are kind of filling a goofy need between the debt equity and the operating experience. I mean, I don't know if what do you think? I mean, I don't know if I'm off track on that or if it's kind of if
No,
it's kind of the.
I think that there's a couple big trends on the buy side, right? That I think are driving this. One of the trends is you have a class of kind of highly educated, very capable and upwardly mobile but somewhat disenfranchised young talent that's saying, I don't want to go work for KKR for the next 30 years or, Fidelity or whatever
Yeah,
it
go
is, or
raise funds for
Blackstone.
Blackstone. Yeah,
Work,
100%.
exactly. And, work like 70 to 100 hours a week for the next 15 years. Like, I just don't want to do it. I'm super, I loved my time here. I want to move back home. I want to move down to the South or wherever. And I want to go and, be involved in the development and the running of businesses. And so there's that whole kind of wave,
Mhm.
and that wave of talent is going to buy small businesses because they don't have the balance sheets to buy big businesses. So it's all basically concentrating, that wave all concentrates in small and lower middle market transactions, which is great for small business owners. The second big, sort of item I think that we're talking about on the buy side is there's no place to earn yield on your money right now, and there hasn't been
Anywhere.
for a while now.
Yeah.
And who knows? Maybe that might change, and the Federal Reserve might have their hand forced with 5% inflation, which is now a reality. But for the last 10 years, and we'll see, what goes from here. There's no place to earn a return on your cash, and so as a result, a huge amount of capital has been looking to find a home
Mhm.
in assets that can yield something attractive. And if your best alternative is basically 25 basis points in risk-free treasuries, then earning like a 12% return or a 15% return in a private company, it used to be like, that capital used to insist on a 25% return, right? Or a
Mhm.
30% return. A lot of that capital doesn't insist on a 25, 30% IRR anymore. It's like 15%, like, let's do it. We have no other, like, let's do it.
Where else,
Where
man?
else are
Yeah,
we gonna put it?
exactly.
Right? Where
Isn't
else
that
are we gonna put
crazy?
it? And so so that's created larger funds, larger fund sizes, more funds, and just an expansion of, of the alternative investment, industry.
It's which is just, I mean, so the 5.1 inflation for the CPI, the consumer price index that you mentioned is one thing, but like Peter, I'm watching that, like, so the throttle that got pushed down, the injection of this capital, like, I mean, it allows the credit creation too. So like the multiples and the inflation of the privately held companies, I'm seeing valuations that I'm like, oh my God, I couldn't imagine being that fund buyer and like trying to deliver whatever IRR you promised to other
Yeah.
people. And and again, so they're and I see like two things at play where like they're going, okay, well, if I'm a general partner at a private equity firm and I have to buy companies to get the rate of return for the investors, and I lose deal after deal after deal because I'm underbidding, you're either going to overpay or you're going to go down market. Which
Yeah.
it seems like I'm really happy I'm not in that position as an individual because it seems like a very small corner to get backed into.
No, I think that's exactly right. I think that, they know that they have to pay more in order to be competitive because there is so much capital available, and and the availability of the capital is pushing down the return requirements on that capital, right? And so if you're going to pay more for the same business, you either need to accept a lower return on your invested capital, or you need to find a way once you own that business to really accelerate the value of that business, right? You really have to do something different with that business once you own it in order to
Get the return.
exactly, in order to get the
I,
return. And so
it's
and so
crazy, man.
that has led to a lot of different methods and techniques that used to be more like optional upside, now being very, very fundamentally required in order to sort of make the math work or to
Hmm.
make the math exciting. And
Hmm.
so private equity firms that used to be generalists and would look at businesses across any industry category have said, let's pick two or three sectors and let's just be animals in those sectors. Let's know everything about them. Let's play to our strengths. Let's get really specific. Let's get really focused. Let's build long, deep relationships and pipelines into those markets and industries. Let's try and get to know the top 100 CEOs in that category. They're doing things like that in order to try and sort of really focus themselves and so that when they own the business, they really actually do have a more credible plan for sort of how to more, to accelerate the value of the business,
Hmm.
and not
Hmm.
just to sort of ride whatever the existing sort of tailwind of growth is that the business was already experiencing. So that's happened a lot in private equity. You have industry specialized private equity. You have private equity that's focused on growth through M&A. So they're not buying businesses unless there's like a consolidation play.
Hmm.
And their plan before they even buy the initial business is, let's go have like
Roll it up.
25 other targets that we're already in conversations with. And the moment we close the initial business, we're already, getting ready to sort of sign up the next
Oh,
one, two, three, four, five businesses. So all these plays are emerging because the availability of capital is putting so much pressure on the private equity operators to really find ways to make money in spite of having to pay much higher prices. And again, it's all kind of good from a business owner's perspective. I mean, you have to ultimately navigate these things and make heads or tails of it, and there's way more buyers that you have to sort through. But if you have a good intermediary, or you have somebody who's good, who's helping you, and you take your time, and you don't want to just sell your business in 2 months, and because you all of a sudden are fed up with it. That's the problem. If you can take the time as a business owner to sort of take advantage of these market dynamics, there's a lot to like
of
about
opportunity.
being an
Yeah. Yeah.
entrepreneur today. But
Yeah.
if you
Yeah.
approach
Yeah.
the market and you're just like, I'm fed up and I'm tired, and COVID really kicked me while I was down, and I just want to sell this thing in 2 or 3 months, it still
Good
doesn't
luck.
really work.
Yeah.
It still doesn't work very well.
Well, yeah, and you brought up a great point, and I know we're getting short on time here. Is that like it's good if you understand how to tell the differences of all that, which is the whole point of this. Even this specific hour is like, the more you know of what questions to ask, the better you can find your ideal match, which is just the point, and then you can use it to your advantage. But if you don't know all of these dynamics that are at play behind the scenes, behind that purchase, the purchase price offer, I mean, you're set up for potentially misaligned expectations, which is a bummer. But I know that we're getting, because we're short on time. Like, I'm curious, like, what is your hopes? With COVID and like all, like whatever the Fed does with the interest rates and the liquidity and all this stuff, it's going to work its way over the years through the system. What do you hope for Axial, and like, what dent do you want to make in this space?
Well, I mean, we codified the mission of the company as focusing on unleashing the potential of private capital markets. I mean, that's and that we some people might feel like that's a highfalutin thing, or it doesn't even mean anything. But for us, what that means is, and we review the performance of the business every Friday. The whole company comes together, and we typically review the mission and the values of the business. So it's very alive in our business. What is it that we're doing? And I guess when I think about what does it mean to unleash the potential of private capital markets, for the benefit of the market's participants, it's really about creating a far more accessible, far more transparent, and far more merit based capital market for small businesses. And when I say merit based, what I really mean is that high quality businesses that have worked very hard to build themselves into high quality businesses are in a position to see all of the options that are available to them, and to be able to operate with a lot of confidence and a lot of trust and a lot of a lot of safety, and hopefully to transact with really high rates of success. And for businesses that have not been developed into really really high quality businesses, it shouldn't mean that they can't be sold. It should mean
Hmm.
that there is an orderly market where those businesses can be financed or can be sold as well. So I think, our goal, what we hope to do through Axial, and frankly, what we hope to do with partners and customers and everybody who sort of works in this market, is get the market to a place where business owners are being rewarded for the businesses that they have collectively built with their teams. Investors are being rewarded for the reputations that they've achieved over the course of time. So great investors, or specialized investors, or investors that have done really well by the businesses that they've bought, have an advantage over investors who have cut corners, or
Hmm.
over investors who have not lived up to what they promised, right? We also hope the same for intermediaries. We
Hmm.
want to see a world in which high quality advice is rewarded, and where low quality advice is exposed because it's destructive to to the market. It's destructive to businesses for low quality advice to be at the table. So I think what we're really hoping for is a world where everybody can access the capital markets that deserves to. Business owners have good line of sight into what it's going to take to successfully transact in a way that they can feel good about, and people can get rewarded for what they've achieved. And it's conceptually, I think, a fairly straightforward thing to articulate. To accomplish it takes time. We need to build up a lot of data on a lot of buyers. We need to build up a lot of data on a lot of sellers. We need to build up a lot of data on the intermediaries. And we're 10 years in, and I feel like we're just getting started. So it's going to take a while.
Peter, I'll tell you what, man, like it's such a noble cause, and what you just described is a world and a marketplace that I want to live in. So like I said, I've been following you for years, and it's a world that I want to live in and root for you and cheer you on as you guys are growing.
You.
Two final questions. And I honestly, that like last little snippet was amazing. So like, I don't want to, I want to overemphasize it. It's amazing. So the last two questions, the word intentional, name of the show. I'd love to know your definition of the word intentional, and then where people can find you.
So I actually have I have a prepared answer for this because I did some homework. For me, intentional is really about it's about the deliberateness with which the growth occurs. So intentional growth. I've always thought it was a great choice when you rename the podcast this. The development of a business should be intentional. Intentional should mean it's deliberate, it's measured, it's carefully considered. You're thinking through the lens of employees, through customers, through shareholders. For me, intentional just means there's a real mindfulness that's coming from the C-suite around how they're, the craftsmanship associated with business building. And that's why I always loved it, and wish I could steal it from you. But no, I think it's a great word, and I think you've used it very well.
Much appreciated, man. It means a lot.
And
we know, I was gonna say we know a couple domains, but why don't you give them the good place to reach out?
You can find me through. I'm available on LinkedIn, very responsive there, and Axial you can find at axial.com. There's lots of free tools on the site, lots of free information. We also have a publication called the Middle Market Review, which you can find at Axial or at middlemarketreview.com. That's a free newsletter that publishes lots of content and information on all kinds of issues related to the purchase and sale of small businesses. So thanks, Ryan, for giving me the opportunity to plug that.
Oh yeah, you bet. And honestly, the newsletter is amazing. I get it every day. That's how I spark a lot of. I've actually interviewed quite a couple of different people from the newsletter. I was like, oh, that's a great topic. So thanks for everything you're doing, Peter.
Yeah, same here, Ryan. Thanks for having me back, and it was great to be with you.